Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The unfolding financial implosion is not going to continue to be primarily centered on banks. As the crisis continues to broaden, it is highly likely going to be dominated by other financial institutions, such as insurance companies, pension plans, REITs, small banks, credit unions, and other financial intermediaries, as they are all swept into the orbit of tightening credit standards, liquidity shortages, counterparty risk, cash flow, and solvency issues. What do these lenders have in common? Two things: U.S. Treasury bill, notes, and bonds, and commercial real estate, or simply I'll call CRE. There is the strong potential for developing waves to be much different and more profound than any previous financial crisis we have yet or likely ever experienced to most of us living today. I've written enough lately about banks, and small business, as well as the U.S. Treasury market. What I haven't discussed, however, is commercial real estate, or the CRE sector, as an extension of that same discussion, a very important extension, which I haven't had the space to delve into. Commercial real estate is massive, $21 trillion in the U.S. alone. Importantly, there are approximately $270 billion of CRE loans due by the end of this year, and already $3 billion have defaulted in March alone. Brookfield on $748 million of Los Angeles office loans, PIMCO on a portfolio of $1.7 billion asset-backed mortgage notes, and Blackstone on $562 million in Nordic CMBSs. These are major players in the commercial real estate market. When they have a problem, that is a very significant and serious issue. Problematic small and regional banks are now caught up in the current whirlwind of action-reaction. Around 80% of CRE loans worth around $2.3 trillion. As expected, now professionals are digging into the details of NAVs, real mark-to-market valuations, net operating incomes, costs of capital, as well as failing occupancies and square foot pricing changes. The question being asked is about the debt coverage ratio. How are any declines here going to impact cash flows and or result in higher default rates? The system seems to have forgotten, after a longer than usual 14-year cycle, that cycles can happen and downturns do come. Both are periods of proven underperformance for CRE. To give some perspective on this, I will cover the subjects listed here. I warned about all this in 2019, in fact, and a little earlier, but in one article in 2019 entitled "The Next Financial Implosion is Not Going to Be About the Banks," published broadly on sites such as Seeking Alpha, Talking Markets, and others, and I quote from it: "The coming financial implosion is not going to be about the large international banks. It is going to be dominated by insurance companies, pension plans, trusts, endowments, and small banks and credit unions. These are the institutions with the bulk of their invested assets in some form of U.S. commercial real estate. The potential for this third wave is much different and more profound than any previous financial crisis we have yet experienced. Most fundamentally, the reasons for this occurring are threefold: the continuing deindustrialization of America and a resulting gutted middle class that is now becoming economically tapped out, ongoing demographics, having an older generation that historically starts spending less, as well as an overall shrinking working age population, and three, the continuing impact of the internet and robotics on job destruction." End of quote. The current financial turmoil we are experiencing is not simply yet another banking crisis. It is an asset crisis across a very broad swath of the financial sector, both domestically and internationally. It is currently about the over $600 billion in unrealized losses on these players' U.S. Treasury holdings, but is quickly becoming about their asset positions in their CRE holdings, both being core holdings and central to their business models and existence. The health of this sector is fundamental to the entire financial sector. Problems here have profound impacts on the U.S. economy overall. Any spillage would be global, as foreign investment in U.S. CRE, as shown here on the left, is immense. The world's two most expensive CRE markets are in fact New York and LA. This is very similar to Japan, when its economic bubble burst in the late 1980s, and they went on to the first of what they call the lost decade. In many ways, it is like the chicken or egg riddle. Which came first, a banking crisis or a CRE crisis? Though it would appear on the surface to be this time a banking crisis, forces of globalization and financialization have driven CRE to levels of non-affordability and instability, without us continuing to maintain historic levels of low interest rates and low inflation. This will take time to play out, however, because this is one of these trades, for example, where people will postpone and avoid as long as possible the mark-to-market reality. Small banks have dramatically increased their share of commercial mortgages versus large banks, now with their deposits fleeing to the safety of higher market money fund yields and their unrealized bond losses enough to place them into insolvency if priced to market. They can ill afford pricing their CRE holdings down, a simple reality that few can willingly accept. The reality, unfortunately, is getting more pronounced daily. Shown here is the VNO over the last 10 years. The VNO is an S&P 500 member and one of the largest REITs in the U.S. with a particular New York City focus. Through the end of 2022, the amount outstanding of commercial mortgage loans in the U.S. stood at $5.6 trillion. Over half of this stock sits directly on commercial bank balance sheets, with small banks capturing a much larger share than large banks, and including mid-sized banks, that is, banks with less than $200 billion in assets. Economists estimate that the combined share of small and mid-sized banks is 80% of the overall stock of commercial mortgage loans. Excluding the securitized CMBS market, banks originated over 40% of commercial mortgage loans in the first half of 2022. What does Wall Street see? They were stung pretty hard on residential real estate in 2008. And with this crisis unfolding, the charts they are kicking out to their institutional clients is quite remarkable. They lost a lot of investor confidence in 2008 and certainly don't want a repeat for their clients nor for their own assets. I showed this chart of the timeline, which unfolded during the 2008 residential real estate crisis recently in a video. It took much longer, as you can see, to unfold than many expected. Our analysis suggests we have the foundations of a major banking, pension, and insurance crisis. Certainly, there is a high probability this is just the start of a major banking crisis. It is still in the first innings of a very long crisis. Before it's over, there is likely to be many more surprising and unexpected failures in the United States and globally. We have a typical recessionary cycle. This one is highly susceptible to quickly getting out of control due to leverage and debt levels, unsound lending standards, and sustained levels of malinvestment from, frankly, monetary malpractice. With roughly $2.5 trillion in the next 5 years, how many marginal players will go bust? We bail out banks, but this is a much bigger problem than simply banking. It's a financial industry problem. What we need to pay attention to is the CRE waterfall sequence of events shown here. Occupancy falls, square foot rental prices then fall, rent rolls fall, building values fall, reserves are consumed, lenders seek more equity to restore the 50% loan-to-value ratio. Equity then walks away. We appear to be about here at the present time, but moving very quickly towards the next waterfall level. As we release this video, I read that one of the largest U.S. CRE players has significantly restricted redemptions on its REIT offerings. The redemption requests surged to $4.5 billion, and they were forced to restrict it to only $666 billion. To make matters worse, this was the 5th consecutive month. This was Blackstone. Blackstone's $71 billion real estate income trust, or what they call BREIT, has restricted redemption withdrawal requests. In Q1, San Francisco's office vacancy rate was just reported to have soared to a record 29.5%. This number stood at just 4% prior to the pandemic. When the COVID lockdown occurred, the IMF was so worried about the impact on global real estate, it issued a major warning as part of its regular financial stability report in April of 2021. This schematic was part of it outlining the linkages of financial intermediaries involved and the critical structural channels that would be impacted as things unfolded. Conceptually, there are 3 key channels through which a decline in commercial real estate prices interact with other financial vulnerabilities to affect financial stability. The first is the solvency channel, as shown here in the upper middle box, which sets in as banks are exposed to credit risk through their commercial real estate loans, as well as to credit and market risk through their commercial mortgage-backed security holdings. A downturn in the commercial real estate market worsens the credit quality of borrowers by affecting the strength of their income streams and balance sheets. In the event of borrower default or large drop in commercial mortgage-backed security prices, banks incur losses and their capital positions are weakened, which in turn leads them to reduce the credit supply to the economy. The second is the collateral channel. The collateral channel results from the use of commercial property as collateral by non-financial corporations to obtain credit from financial institutions. A decline in the value of this collateral during a commercial real estate market downturn is likely to limit borrowing by such corporations, curtail their investment, and dampen general economic activity. The collateral channel could also reinforce the bank solvency channel because a drop in collateral values increases the loan-to-value ratios of existing commercial real estate loans, which in turn raises the value of banks' risk-weighted assets because of an upward revision of real estate loan losses given default parameters and reduces their regulatory capital ratio. Third is the commercial real estate debt and equity investments by non-bank financial institutions, such as insurers, pension funds, and investment funds, constitute another channel that affects financial stability. If commercial real estate prices decline, the value of assets held by these investors falls, and they are less willing or able to provide new financing. Insurers, for example, are subject to regulatory solvency constraints. In addition, investment funds may face redemption pressure from end investors following a drop in performance, which may lead to fire sales of commercial real estate assets. Given the high liquidity of commercial real estate and large maturity mismatch of property investment funds, the impact on prices, in turn, could be significant. This channel can also amplify the bank solvency channel, as some non-bank financial institutions, such as property investment funds, are leveraged and rely on debt financing from banks. We are carefully monitoring these, and they are all becoming quickly disconcerting. You might want to cut and paste this chart as something to carefully watch. Performance of the sector is quickly deteriorating overall. This chart shows U.S. companies sensitive to CRE versus the S&P 500. This is based on a J.P. Morgan basket. This chart shows Bloomberg's office's REITs versus its overall U.S. REITs. Real Capital Analytics shows here that property price decline in this cycle at negative 1.3% average decline per month is tracking slightly worse than the 2008 financial crisis at approximately a decline of 1.06. The long-short ratio has been fading for a long time, but there is more room to the downside should people decide taking the ratio to the 2018 or 2019 lows. Clearly, overall confidence in the sector is beginning to border on freefall. What is in freefall is the transaction prices of U.S. office real estate dollars per square foot. We're witnessing price drops on the closing prices of office space from the area of $265 per square foot to $195 per square foot, or just over 26%. The current rental rate is approximately $75 per square foot. If those discounts start flowing to rental rates, There's going to be many CR office real estate holders going to go bankrupt, which we'll get to in a moment, but it gets worse. We have to factor in the actual occupancy of the hundreds of millions of existing office real estate. And before we get to that, we must realize that a lot of that space is not being paid for multiple reasons. In fact, no rent is being paid on approximately 20% of all U.S. office space. The national average occupancy level in the 10 largest select metro areas is only 50.4%. It's tough to sustain a business or commercial mortgage-backed security values with these levels. The recovery since COVID-19 has been dismal, and clearly the advent of the Zoom workplace is still having a crippling impact, and that is likely to sustain itself. As a consequence, office appraisal values have fallen 25% over the past year, with a 10% decline in February alone. It would appear in these 10 centers that 50% has become a ceiling. This is a ceiling that the financial community will soon have to price in. They will no doubt hold as long as possible, hoping something happens. A recession is not what they need or can handle. Unfortunately, when we look at the country in a broader context and consider 50 of the largest U.S. metro areas versus the top 10 we just looked at, the numbers get dramatically worse. The average drops to 18.85 for the top 50 U.S. metro centers. I don't know how much worse things can get before it absolutely cascades into a serious catastrophe. Here's where it gets interesting and where the rubber meets the road as we speak. That is in the pricing of credit and credit risk for the office CRE segment. It can only be described as collapsing as measured by what is referred to as CMBX or commercial mortgage-backed security derivatives. These are similar baskets like the hybrid CLO and CDO securities that we were stunned to understand and learn about during the 2008 residential crisis, but are in fact derivative indexes of something very similar. Shown here is the CMBX, as they're called, for the Series 15 with a BBB negative rating. Here is a simple way of looking at the structure without trading prices and shows the CMBX Series 15 at the bottom with high concentration of office properties. As the illustration shows, there are various series of these CMBX derivative indexes that come with a mix of types of commercial real estate. The higher the percentage shown, the higher the concentration of that type of commercial real estate. Office, retail, and hotel are currently the most problematic areas. All the series trade with risk-adjusted prices, such as BBB, as I just showed. The spectrum of types of financial intermediaries that traffic and all the various versions of these products is vast. You can also see that these financial entities specifically dealing with office and retail CMB derivatives and REITs products are significant. Anything that's impacting this is extremely broad-based, domestically and globally. In aggregate, we have only seen one period worse, and that was during the 2008 financial crisis. The focus today is to avoid high office, retail, and hotel percentages. What is currently considered safe is multifamily and mixed-use properties. These areas are holding up the overall percentages from appearing worse than they already are. The perfect storm to hit this weakening edifice is in the area of debt maturity rollovers, particularly during periods of tightening lending standards and a banking crisis scare. It couldn't come at a worse time. However, a compounding core problem is the proliferation of floating rate loans, where interest rates reset more frequently. About 48% of debt on office products that matures this year has a variable rate fee. Thanks to the Fed's rate hikes, landlords have been forced to purchase interest rate caps, which limit payment increases when rates rise and have also become more expensive. Think of it as hawk insurance. The price for 1 year protection on a $25 million loan with a 2% rate cap soared to $819,000 in February from only $33,000 in early March 2022. Even for owners who haven't defaulted, the maths have become a lot more complicated. Blackstone's Willis Tower in Chicago, I saw, has roughly $1.33 billion of commercial mortgage-backed securities and has seen monthly payments on that debt jump nearly 300% in February from a year earlier, according to Bloomberg data I saw. A Blackstone spokeswoman said the building is highly occupied with long lease terms. Thank goodness. In 2023-24, about $1.1 trillion debt is maturing, comprising 32% held by banks, 25% held by CMBS holders. Looking at this $1.1 trillion debt maturity by property type, office loans amount to 23% of that debt, while multifamily accounts for 31%, followed by another 10% each for the industrial, retail, and hotels. This is with a bank crisis where specifically smaller and regional banks, who dominate the actual lending, are watching their deposits disappear and asset values like U.S. Treasuries swirl down to a negative over $600 billion in unrealized loss positions. They just don't have the wherewithal to continue to finance if they can stay solvent. In many cases, it is going to be difficult to get the rollovers financed, and the delinquencies will skyrocket along with bankruptcies. The office commercial real estate subject is a huge subject that requires much more discussion than we have space for here. I have just tried to get your attention on the subject in this session. I'll write more on it in our weekly newsletters as events develop. So what is the net of what we can conclude? In the U.S. financial crisis of 2007 and 2008, the cumulative loss rate for commercial mortgage-backed securities and commercial real estate loans was approximately 14% and 8%, respectively, which translated into a much higher likelihood of bank failures for U.S. commercial banks with high commercial real estate exposures, particularly smaller banks. We have a chicken and egg, where what hurts the bank hurts CRE. What hurts CRE hurts the banks. In all the talk in the press, there has been almost no talk about half of this chicken and egg dependency. Obviously, we have just seen that this is happening and will soon be newsworthy for mainstream business reporting. Investors don't wait for the news to catch up, or they'll soon no longer be investors, but simply roadkill. We also need to remember the discussions we had previously about what occurred during the 2008 financial crisis and the 1974 bear markets, when the Fed actually started lowering rates, as we're all expecting, and shown here in the highlighted orange area. Unemployment surged, but the economy noticeably weakened, and though rates were falling, markets continued and, in fact, accelerated lower. It is likely that is what we're going to see again. CRE sector will actually witness its worst destruction during the period when the Fed is lowering rates. As counterintuitive as it sounds, it is the nature of markets. The markets at that point are ignoring what will actually help the CREs, but are discounting a seriously weakening overall economy. Monetary policy comes with an 18 to 24 month lag. A lot of damage can be done in that period of time, even if the markets discount forward 6 to 8 months. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as no one will actually take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. Powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and a global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has actually seldom been a better time for investing. However, it requires careful analysis and not necessarily following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2023 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.